Have you ever thought that buying a house could be the biggest financial mistake of your life? Warren Buffett, the legendary billionaire investor who once called real estate a great investment, now says, don't buy a house. So what changed? And why could this warning be the key to protecting and growing your wealth? If that got your attention, like the video, share it with someone who needs to hear this. Leave your thoughts in the comments and subscribe to the channel. Let's get straight to the point. Warren Buffett's shift on real estate. Back in 2012, during the recovery from the global housing crisis, Warren Buffett said that if he could, he'd buy a couple 100,000 single-family homes as an investment. At the time, he saw real estate as undervalued and full of upside potential, especially with mortgage rates at historic lows. The context was ideal. Home prices were still recovering after the 2008 crash. Inventory was plentiful, and financing was highly accessible. It was a golden moment for anyone looking to safely invest in physical assets. But more than a decade later, Buffett's stance has changed dramatically. In recent interviews and Berkshire Hathaway's annual meetings, he made it clear residential real estate is no longer attractive as an investment. Why? Buffett is a value investor. He buys assets that generate cash flow and have long-term competitive advantages. And today, the real estate market, especially the residential side, has lost much of its appeal. Prices are inflated, interest rates are high, and the red tape is relentless. He also points out that there are now far more efficient investment options, lower costs, higher liquidity, and better return potential. In short, the risk and effort no longer justify the possible reward. Real estate versus stocks. Returns and effort. Let's talk numbers. Over the past 50 years, the average annual appreciation of residential real estate in the U.S. has been 4.3%. The S&P 500, which tracks the 500 largest U.S. companies, has averaged 9.8% per year. That's more than double. And that's without the headaches. No roof repairs, tenant calls, or drawn-out negotiations. Real estate demands time, energy, and capital. Stocks? Just a few clicks, anytime, anywhere. Real estate often eats up more than just money. It also consumes your free time, time that could be used to build new income streams or level up your financial education. Picture two people with the same amount of money. One buys a property, the other invests in stocks. After 20 years, the difference in returns could reach hundreds of thousands of dollars, especially with dividend reinvestment. While one is dealing with repairs, missed rent payments, and physical wear and tear, the other is reading reports, making smart moves, and automatically reinvesting profits. That difference in quality of life matters too. This isn't just about numbers. It's the difference between a comfortable retirement and one limited by financial strain. The downsides of real estate investing: real estate can be appealing, but you need to see the other side of the coin. Here are some key drawbacks. Low liquidity. Selling a house can take weeks or even months. Need quick cash? You might have to accept a much lower price. In times of crisis or urgent financial need, this lack of liquidity can be a disaster. You're stuck waiting for buyers, navigating negotiations and bureaucracy that could derail your plans. Hidden costs: legal fees, taxes, insurance, renovations, maintenance, delinquent tenants. All these eat into your actual returns. Many new investors get excited by a property's projected appreciation, but forget to calculate recurring expenses that quietly drain the profits. Complex process. Buying and selling real estate is a bureaucratic nightmare. Agents, lawyers, inspections, paperwork, and lots of extra costs. On top of that, legal or regulatory changes in specific regions can increase costs or drastically reduce a property's value as an income-generating asset. High interest rates. In many countries, mortgage rates are now over 7% per year. That drastically increases the overall cost and reduces net returns. So even if the property appreciates, a big chunk of that gain can be wiped out by interest, not to mention the risk of defaults or local market downturns. Imagine investing in something you can't quickly sell, that constantly needs maintenance, and that's vulnerable to high interest rates, regional crises, and regulatory shifts. Why stocks outperform real estate? Now let's look at the other side of the scale. Instant liquidity. You can buy or sell stocks in seconds. that gives you the flexibility to adapt and react to market changes. Unlike real estate, where transactions can drag on for months, the stock market lets you move in real time, taking advantage of opportunities or avoiding losses. Passive management, ETFs, index funds, and dividend stocks give you exposure to the market with minimal effort. No calls about burst pipes. With today's tech, you can automate monthly contributions, rebalance your portfolio, and reinvest dividends, all from your phone, hassle-free. Opportunity and volatility. Unlike real estate, volatility in the stock market can be an advantage. Temporary drops let you buy high-quality stocks at a discount. Imagine buying a solid company for 20% less because the market panicked. That kind of opportunity just doesn't happen in real estate with the same frequency or intensity. Scalability. You can invest in dozens of companies with just $100. Real estate diversification, much harder and more expensive. Stocks let you spread your risk across sectors, countries, and assets with very little capital. That kind of diversification is almost impossible with real estate unless you're a millionaire. And don't forget, stocks often offer something real estate rarely does: regular, growing dividends. Companies like Apple, Microsoft, and Johnson & Johnson pay out billions every year, and you can get a slice of that. When real estate makes sense. But not everything is black and white. There are times when buying property makes sense, and Buffett acknowledges that. Primary residence. If you're planning to live in a home for decades, buying can make more sense than renting, especially in stable regions. The emotional and financial security of owning your home is important, especially when rents are constantly rising in major cities. Low interest rates. In 2012, mortgage rates were below 3%. That was a once-in-a-generation opportunity. Those who bought then saw great returns. But today, with rates over 7%, the math changes entirely. That 4% difference in interest over 30 years can mean hundreds of thousands of dollars in extra payments. Timing matters. Specific markets. Cities like Austin, USA, Lisbon, Portugal, or Dubai, UAE, have unique dynamics. In fast-growing areas, real estate can outperform. But even then, you need research, planning, and risk assessment. Buying out of fear of missing out is a surefire path to regret. Diversification. If you already have a strong portfolio of stocks, owning a property can add diversification, but it shouldn't be your core investment. Diversification helps protect against the unexpected, but only when done with balance, knowledge, and a long-term vision. If you love the game, if you enjoy negotiating, renovating, dealing with tenants, and know the market, you might do well. But no, it's not passive and it's not easy. Real estate can be a great opportunity if you turn it into a profession or business. But for the average investor, stocks usually offer more return with less stress. In short, real estate can be a good investment, but it requires effort, knowledge, and the right timing. For most people, stock ETFs are more efficient, simpler, and more profitable. It's not about never buy a house. It's about not buying for the wrong reasons. Warren Buffett didn't change his mind by chance. He's simply doing what he always does, analyzing the numbers, the context, and going for the best cost-benefit ratio. Real estate can work, but it rarely beats the returns, convenience, and liquidity of the stock market. So before you sign up for a 30-year mortgage, think carefully. Is it really worth your time, money, and freedom? If this video gave you a new perspective, like it, comment, and share it with someone thinking of buying a house right now. And of course, subscribe to the channel for more content like this. And remember, your financial freedom journey starts now. Click the link in the video description to unlock your free ebook packed with investing insights, mindset tools, and strategies to grow your wealth.